Every so often, a market reveals a simple but powerful imbalance. Too much demand, not enough supply. And when those two forces collide, the result can be explosive. We've seen it in commodities, we've seen it in equities, and occasionally we've seen it in assets that most people weren't paying attention to until it was too late. Which brings us to silver, a market that sits at the intersection of finance and physical scarcity, a market where billions of ounces trade on paper, while a much smaller pool of metal actually exists in deliverable form. So the question is not just theoretical. Is a silver squeeze possible? Or more precisely, under what conditions could it happen? Before we talk about silver specifically, we need to define the term. A squeeze occurs when market participants who are short, meaning they've sold something they don't own, are forced to buy it back at higher prices. This can happen for different reasons. In a short squeeze, rising prices force short sellers to cover, which pushes prices even higher. In a supply squeeze, physical availability becomes constrained, and buyers compete for limited inventory. The most powerful squeezes tend to combine both. Silver is not just another commodity, it has a dual identity. And the result is not on one side, it is a monetary metal pricing, held as a store of value, often compared to gold. On the other, it is an industrial input used in electronics, solar panels, medical applications, and more. Annual mine production typically comes in around 800 to 850 million ounces, with recycling adding another 150 to 200 million ounces, bringing total supply to roughly 1 billion ounces per year. Industrial use alone consumes approximately 550 to 600 million ounces annually, or well over half of total supply. When you add investment demand, jewelry, and silverware, total demand frequently meets or even exceeds annual production. Investment demand can surge during periods of financial uncertainty. Industrial demand can grow steadily with technological expansion. And importantly, supply does not always respond quickly. Most silver is produced as a byproduct of mining other metals like copper and lead, which means production is not always sensitive to silver's price alone. This is where the first layer of potential imbalance begins. Now we add the financial layer. On exchanges like COMEX, silver is traded primarily through futures contracts. Each contract represents 5,000 ounces, but the total volume of contracts, known as open interest, often represents many multiples of the physical silver available for delivery. This creates a system where price is largely determined by financial positioning rather than physical exchange. Under normal conditions, this works efficiently. Most participants never intend to take delivery. They trade exposure, not metal. But it also creates a dependency. The system assumes that behavior remains consistent, that most participants will settle in cash, that physical demand remains manageable. A squeeze becomes possible when those assumptions begin to break. For a meaningful squeeze to occur, several conditions would likely need to align. First, a sustained increase in physical demand. This could come from investors seeking hard assets or from industrial users competing for supply. Second, tightening physical availability, declining inventories, reduced mine output, or logistical constraints. Third, a shift in behavior, more participants choosing to take delivery rather than roll contracts. And fourth, financial pressure on short positions. As prices rise, shorts are forced to cover, adding fuel to the move. None of these factors alone is sufficient, but together they can create a feedback loop, and that is where things become interesting. To understand what this could look like, it helps to look at other markets where similar dynamics have played out. In the late 1970s, silver itself experienced a dramatic move. Prices rose from around $6 per ounce to nearly $50 in a relatively short period. That move was driven by a combination of monetary instability, investor demand, and concentrated buying pressure. While the structure of the market has changed since then, the underlying principle remains. When demand overwhelms available supply, prices can move far beyond expectations. More recently, we've seen similar dynamics in other assets. In 2021, GameStop became the center of a short squeeze. A heavily shorted stock met coordinated buying pressure. As the price rose, short sellers were forced to cover. The result was a rapid, self-reinforcing move, with the stock price surging by over 1,700% during its peak. While silver is a much larger and more complex market, the mechanism is similar. Pressure on one side of the trade can cascade through the system. Some of the most dramatic price moves in financial history share a common trait: limited supply. Consider Bitcoin. Its supply is fixed by design. When demand surged, there was no way to increase production. The result was a series of rapid price expansions. Even in commodities, we've already seen how quickly a squeeze can unfold when supply is tight and positioning becomes one-sided. In March 2022, the nickel market experienced one of the most violent squeezes in modern financial history. Prices moved from roughly $27,000 per tonne to over $100,000 per tonne in just a matter of days, a gain of more than 250%. This wasn't a slow repricing, it was a cascade. As supply concerns intensified, particularly around Russian exports, short positions began scrambling to cover. That buying pressure drove prices higher, which triggered margin calls, which forced even more buying. At its peak, the move became so extreme that the London Metal Exchange halted trading entirely. The key takeaway wasn't just the magnitude of the move, it was the speed. A relatively tight physical market, combined with concentrated financial positioning, produced a price explosion that overwhelmed the structure of the exchange itself. And that dynamic, tight supply meeting forced buying, is exactly the kind of setup that defines a true squeeze. This wasn't a slow repricing, it was a cascade. As supply concerns intensified, particularly around Russian exports, short positions began scrambling to cover. That buying pressure drove prices higher, which triggered margin calls, which forced even more buying. At its peak, the move became so extreme that the London Metal Exchange halted trading entirely. The key takeaway wasn't just the magnitude of the move, it was the speed. A relatively tight physical market, combined with concentrated financial positioning, produced a price explosion that overwhelmed the structure of the exchange itself. And that dynamic, tight supply meeting, forced buying, is exactly the kind of setup that defines a true squeeze. Markets are not driven by numbers alone, they are driven by behavior. A squeeze requires not just structural conditions, but a shift in perception. Participants must begin to believe that supply is tight, that delivery matters, that holding the asset is preferable to trading it. This shift can happen gradually, or it can happen quickly, triggered by a specific event or narrative. Once it begins, it can reinforce itself. Rising prices attract attention. Attention attracts new buyers. And new buyers increase pressure on the system. It's important to balance this discussion. There are also strong arguments against the likelihood of a sustained silver squeeze. First, the market is large and globally integrated. Silver is produced and traded worldwide. Second, exchanges have mechanisms to manage volatility. Margin requirements can be adjusted. Rules can change. Third, many participants in the futures market are not vulnerable to forced covering in the same way as retail short sellers. They are hedged, diversified, and experienced. And finally, physical supply is not static. Higher prices can incentivize increased production and recycling over time. These factors can dampen or delay squeeze dynamics. So where does that leave us? Somewhere between possibility and uncertainty. A silver squeeze is not guaranteed, but the ingredients for one, under the right conditions, are not entirely absent. This is what makes the market interesting. It is not just about what is happening now. It is about what could happen if certain variables shift. Tight inventories, rising demand, changing behavior. These are not constant, but they are observable, and markets often move not when something is obvious, but when something begins to change. For those paying attention, several indicators tend to matter. Take COMEX vault inventories. As of early 2026, total silver held in COMEX warehouses has fallen to roughly 360 million ounces, down from about 530 million ounces just a few months prior, a decline of over 30% in less than half a year. More importantly, the deliverable portion of that supply, registered silver, has dropped below 90 million ounces, a level many traders watch closely as a kind of functional buffer for deliveries. At the same time, open futures exposure remains in the hundreds of millions of ounces, which means, in simple terms, the ratio between paper claims and immediately available metal has widened. Zoom out further, and the pattern isn't isolated to COMEX. On the Shanghai Futures Exchange, silver inventories have fallen to levels not seen in years, down nearly 89% from their 2021 peak, with recent readings hovering near multi-year lows. Individually, each of these moves could be explained. Inventory shifts, geographic flows, arbitrage between markets. But taken together, they point in a consistent direction. Physical silver, at least within major exchange systems, is being drawn down. The idea of a silver squeeze sits at the intersection of structure and behaviour. On paper, the market is deep and liquid. In reality, the availability of physical metal is more limited. Most of the time, that distinction doesn't matter, but markets are defined by the moments when it does. When assumptions are tested, when behaviour shifts, when supply and demand stop moving in quiet balance and begin to collide. Whether silver reaches that point is uncertain, but the possibility itself is what keeps experienced traders watching closely. Because in markets, the most interesting opportunities often exist, right at the edge of what most people still consider unlikely.